Hi, this is David with the Enzo Trading System. This is going to be a video on risk management. It's a topic that we touched upon previously many times, but it was being mostly spread across multiple videos. So I thought it was going to be good to ideally possibly put all together into a brief summary. And this video would be it. We'll see how long it takes. So first, going for a definition of risk management. I would define this as staying alive while making profit. Really, the goal when trading is trying to avoid the black swan events, and whether it's market driven or something wrong with the system. And of course, that's harder than it seems. The longer you're in play, the easier it is to get into some major trouble. And then making profit by itself is also pretty difficult. So put together, it's very hard, but that's the name of the game. So here I put what I consider 3 pillars of risk management. It's as a personal assessment. I believe to be true, but let's see how it goes. So first, diversification. I think everybody will agree on that. Ideally, you don't want to be in a specific single market. You don't want to put all the eggs in one basket. You want to give chances to different kind of markets. And then even within the same market, or in multiple markets, use different methods, use different algorithms, approaches. That they all ideally are supposed to work well, but perhaps work on a different set of time frames, have a different levels of risk. And then, of course, with that comes portfolio management. So depending on the ability to the productivity of a certain market, one allocates more or less on that specific market. So diversification is really, I guess, a key. But with that, I mean, you have to evaluate how to diversify, and here comes the quantitative assessment. I believe this to be a must. It's one of those things for which computers are built for. Really, the only reason why one wouldn't use it is, frankly, it's kind of difficult to set up infrastructure to do the calculation and the testing, and to have a statistical assessment. It's been a learning process for us as well. But I think it's pretty much a must. And so when you do a quantitative assessment, what you do, ideally you build infrastructure to simulate a set of trades, possibly multiple markets, and the simulation allows you to replay history and take different decisions and see which decisions would have been best. Of course, it's a bit harder than that. You don't want to have a perfect history, otherwise you incur into the sin of overfitting. You do want to have a more statistical assessment, but we'll spend a few words on that in a little bit to make it more clear. And quantitative assessment cannot be done by a human. It's just I mean, humans can process a lot of stuff, but they're not really rigid with numbers. So yeah, if you think they can make a quantitative assessment of the market, I think chances are you're delusional. I mean, to some level one can do it, but to actually put it into effect and to compete with a system that is built by humans, plus the infrastructure of the computer to do the calculation and the testing for you, I think there's just no match. So last, but equally important, is a real-time stop loss. And I will call this an exception, because the general rule is really you want to be in a open or closed position, whether in a certain long or short direction, depending on where you think the market is going to be. But beyond a certain point, if your loss in a single position exceeds your allowed risk, then it should be closed. That's kind of an abrupt solution, but it's necessary to limit the risk. to limit especially the accumulation of loss. So, and as I said, this is pretty much the only time where it's kind of an exception in the logic of prediction, but I think it's necessary. And many don't use it. I think many will feel that diversification is important. As long as I'm in 100 markets, then I don't need to look for a real-time solution that will get me out of the market. I think that's a mistake, of course. We've seen how markets, they can all align with each other when there is like a particular negative event. So those are those cases where you want to have a real-time stop loss, never without. So these are the three pillars. So now to give a couple of technical secrets, not really secrets, stuff that I mentioned before, stuff that many others use, but I would like to give my support for these approaches. The first one is to prefer a statistical assessment. So whenever possible, perhaps use Monte Carlo methods, meaning that it's basically a quick way to have a what-if scenarios. So it allows you, again, if you have a calculator that can test things thousands, hundreds of thousands, millions of times, you can only get benefit from a Monte Carlo approach. And the second one is a strong bias against drawdowns. So whether you use Monte Carlo or not, your performance, you will have a numeric performance value that is based around profit, I suppose. Then you do want to divide that value by maximum drawdown, localized maximum drawdown. And I think it's important to actually do division. So you take the profit, for example, and then you don't subtract the maximum drawdown, you actually divide. And the reason is that drawdowns, it's really at the core of loss, of potential catastrophic loss. You want to have a very strong bias against it, and a division, it basically behaves like as an exponential effect. And it means that you can look back for your portfolio management for quite a long stretch of time, and then if there's a localized recent maximum drawdown, then the division will have a strong bias against it. And if you use it properly, then your allocation for that asset, for that algorithm, for that whatever you're doing is going to be quickly diminished, and you're going to get quickly out of trouble. So regarding this, I want to show some live trades, some recent live trades. So about 10 days ago, I made a report where we were all happy with the profits. Then the market started moving sideways, and in particular on FTM, we got a string of losses. Not in, I mean, yeah, you could feel the loss, but not into major for two reasons. First one, of course, we had the stop losses. 1, 2, 3, 4, 5, 6 actually. We got in a row. And secondly, yeah, it was the portfolio management that quickly got us out of this trouble. So we can see here FTM. I think I should make this smaller. FTM, we have 1, 2, 3, 4, 5, 6 stop losses in a row. And the first loss was almost $400, 384, and then 377, 200, and then the last one was basically $100. So what happened here is as more and more stop losses were accumulated, the portfolio management was allocating less and less. And even though we use 3 months of trading data, having a division by the maximum drawdown meant that there was indeed a strong bias against it, and it quickly, the allocation for FTM, it quickly went to 0. And then even though FTM continued to underperform and do all sorts of weird things, take more losses, we didn't get any more of those because of that. So that's kind of a really key. You may do some testing in your portfolio management and decide that perhaps you don't want to be biased necessarily against the maximum drawdown. There are cases in which one does the testing and divided by the maximum drawdown gives worse performance, may give even perhaps worse maximum drawdown, paradoxically enough, meaning that you don't get improvement in maximum drawdown itself, but longer term, it's kind of like one of those logical biases that you want to have into the system. I don't know if that sounded confusing, but that's the gist of it. So, and the third bonus secret, again, it's not that big of a secret, but something that we definitely use, something that makes sense, that it's worth keeping in mind when optimizing, is that of looking for a convergence when optimizing for values. And I will show here another example. So in a previous video, I showed this our portfolio management research tool that we use to decide which strategy is better to use for portfolio management. And here, to recap, I mentioned Monte Carlo also in this case. We do use a Monte Carlo approach for optimizing. And then we also divide by the maximum drawdown. And this gives us this pretty good optimal value for the return over maximum drawdown. So return is 30 times, maximum drawdown is 10% for this given span of time, and return over maximum drawdown is this value. So that's the tool. Now, one thing to notice is that here the number of days that we use as a sample is 90 days. So meaning that what the system does in a walk-forward fashion, I will look for the previous 90 days, we'll make an assessment, what is the Monte Carlo of the profit, and then divide it by the maximum drawdown, get that value, and the market that has the algorithms that are operating on the markets that have the best value as far as Monte Carlo divided maximum drawdown for the 90 days of trades, they get the most allocation. But the reason for 90 days, it's really, it was kind of a manual research that we did. And the goal really is looking not for the number of days that give you the best possible value for whatever criteria you're using, but for the number of days that beyond which if you increase the amount of samples, you actually don't get as much as a fluctuation of profit of your criteria. I will show here an example. So let's say that I only use 1 day for sampling. So in this case, I will use only 1 day worth of trades to decide. And here I have return over maximum down is almost 50. It's fairly poor. So if I do 2 days, now it's 46. 3 days, 60. So it's better. So 3 days is better than 2 and 3. And now 4 days, my criteria is 25. Now suddenly it's less than half than 3 days. So what we're having here is a function that it fluctuates quite a bit. So here is this value, this RMD. Ideally, I would like to have it the ideal number of days, but at the same time, there's a statistical assessment, which is perhaps the ideal number of days is 5, but what if it's 4, or what if it's 6? Does it change a lot? So it's kind of like adding a dimension to a value that you're using. If going a little less and a little more, the result fluctuates quite a bit, then you're kind of whatever is the function that is underlined, which is of course very complex because it's not analytical in this case. It has a lot of fluctuations and you cannot rely on it. So if you go forward, then yeah, you still have fluctuations. Actually, let me move to slightly different criteria because Monte Carlo is too slow. Increasing, you have you still fluctuates between 30 and 19, and then after a while 60, 50, you still already have a fairly low value and it still fluctuates. And then after a while you reach around 90, and then it stabilizes around 200 return over maximum down. So now we have a high value, but more than that, we have a value that is stable. Still, it's going to stick around 200 forever, pretty much, under 20 days. So now the function, it looks like something like this. So with the few days, it will go up and down, and then as we increase the number of days in sample, yeah, there are fluctuations, but there are less, and that means that we reach a point of convergence, and that's what we want to have. And that's pretty much how we selected 90 days here for this value. So yeah, I mean, this is nothing new. I think looking for a stability of a function, looking for a value that will converge towards a certain more stable result. It's nothing new, but it's definitely something that worth looking for if one is optimizing for anything. It's always worth keeping in mind, whether you're doing it manually or whether you're introducing stability through a different system, automated system. So yeah, and that was kind of a more like a geeky technical view of the things. But yeah, to make a summary, risk management is of course essential. You need to stay alive so that you have enough funds to continue to fight for another day. And my personal 3 pillars, yeah, first diversify, but also have a system that allows you to do quantitative assessment. But a quantitative assessment is not a person that looks at charts or looks at results and makes an assessment. You want to look in the past, you want to look statistically, and you want to look as far as possible, and do use computers. And then of course a real-time stop loss. If you have a diversified portfolio but you don't have a stop loss system, means when the stock market and crypto, they all crash together, you're gonna crash with them, because then diversification means nothing when that happens. Diversification is one, I would say, necessary pillar of risk management, but it's not enough. That would be my video on this. Hopefully that was useful. I think it went a little bit longer than I expected, but as usual, I'm passionate about this stuff, so I can talk for hours about this. If you have any comments, questions, as usual, we're on Discord, or you can leave comments and stuff. Fun, yeah.